housing market to a supermarket, the shelves are starting to be restocked.
Oh, good news.
All right. That's something that the housing market has been really burdened with the last few years is just supply. We haven't had a lot of homes. So if you walk into the supermarket, the shelves are not fully stocked, but they're more stocked than they've been in the last 3 or 4 years. And that's comforting news for those looking to buy a house.
That is comforting.
Has he been to the supermarket lately? Because I was there yesterday and I bought the bare minimum and it was $150. I came home still baffled by how expensive it was and double checked my receipt. So if the housing market is comparable to the supermarket, I don't really think that's good news. I mean, do you? That was Realtor.com's senior economist, Ralph McLaughlin, commenting on how the housing market is improving. It's true, inventory is up, but so are home prices in most markets across our country. In fact, Redfin reports that nearly 1 in 10, 8.5%, homes in the United States are worth $1 million or more, the highest share of all time. That's up from 7.6% from a year ago and more than double of the 4% share before the pandemic. At the same time, mortgage rates have started to come down, and most industry experts are predicting this trend will continue, including Redfin CEO Glenn Kelman, who told analysts on last week's earnings call that we expect mortgage rates will stay low through the winter and into next spring, which should lead to a much stronger housing market in 2025. I believe the housing market is about to get better. He then got pretty colorful when asked what plan B is if mortgage rates don't come down. He said, and I quote, "Great question. Plan B is drink our own urine or our competitors' blood. Stay in the foxhole." After he promised to drink bodily fluids, Kelman added, "The last earnings call ended with me singing a line from a Who song, Won't Get Fooled Again, where I had said we're not banking on low rates when other people thought they might come down. We're ready to take share if the market grows, we're ready to take share if it doesn't, but we're not going to ease off." Fortunately, I don't think we're going to have to witness Kelman's thirst for blood or urine, which honestly grosses me out, as most industry experts do believe mortgage rates will continue to go down for the rest of the year, as mortgage rates plunged to 6.47% for a 30-year fixed mortgage, the lowest in over a year for the week ending August 8th, according to Freddie Mac. And with inflation losing steam and the economy cooling, there is talk that the Federal Reserve may make not just 1, but 2 rate cuts by the end of the year. But we need more than just rate cuts to increase affordability, as home prices have gone up more than 40% in the last 4 years in most markets due to a lack of inventory. A recent Realtor.com analysis found that 86% of homeowners have a mortgage interest rate of under 6%. Understandably, many feel locked in, unwilling to trade in their super low rate for today's higher rate if they sell and then buy again, therefore constricting inventory. As Lance Lambert writes in his article for Resi Club titled, "Housing affordability is crushed. Subsidies that increase homebuyer demand could make it worse. Overheated home price growth, coupled with the ensuing mortgage rate shock, with the average 30-year fixed mortgage rate jumping from under 3% to over 7%, has created the fastest ever deterioration in housing affordability." He then goes on to write about Vice President Kamala Harris's plan for addressing crushed housing affordability and increasing inventory by spurring the construction of 3 million housing units in her first term. So let's take a look at what she's saying to see if her plan will actually help potential Americans wanting the American dream of home ownership, or if it will hurt them. Federal assistance for first-time homebuyers. The Harris campaign says its plan would allow over 4 million first-time buyers over 4 years to get significant down payment assistance on average of $25,000, creating a tax incentive to encourage builders to build starter homes. It would complement the neighborhood homes tax credit, the Harris campaign says. An expansion of existing tax incentives for builders that build rental housing that is affordable, creating a $40 billion innovation fund that would empower local governments to fund local solutions to build housing. Lambert points out some flaws in Harris's plan. He writes that, as the country saw firsthand during the pandemic housing boom, housing demand can jump quickly, but total housing stock cannot respond as swiftly. So even if we assume that Harris's plan could increase new construction to some degree, it would be a gradual increase. It would take years to materialize. Meanwhile, the increase in housing demand from the 25,000 $25,000 first-time down payment assistance would be felt immediately once it went into effect. He's not wrong. If you give millions of first-time homebuyers $25,000 down payment assistance, there will be many more new buyers in the market, which will dramatically increase housing demand. More demand without more inventory will make home prices go up due to the competition, and that will make housing affordability even worse, especially in the Midwest, Northeast, and California housing markets, where active inventory for sale remains well below pre-pandemic levels, according to Resi Club's data. As far as supply, most housing analysts agree with Harris that the U.S. housing market needs more homes. Over the last several years, our research on the housing supply deficit has been widely followed. And while we've seen housing inventory improve slightly, a substantial undersupply still exists and remains one of the most significant obstacles facing the housing market today, said Len Kiefer, Deputy Chief Economist at Freddie Mac. Freddie Mac estimates that the U.S. housing market is 1.5 million units below a balanced market. And to bring the vacancy rate, both rental and homeowner, back in line with historical averages, the U.S. would need to add an additional 1.5 million vacant for sale and for rent homes. The actual housing shortage, Freddie Mac told Resi Club, is more like 3.8 million units. Lambert points out another problem for Harris. Not only would homebuyer handouts accelerate housing demand faster than housing supply, but the realities of supply capacity would also be a significant roadblock to her goal of adding 3 million additional homes beyond the current trajectory during her sought-after 4-year term. The data shows that since January of 2020, the U.S. has completed an average of 1.39 million housing units per year. To achieve 3 million additional housing units beyond the current trajectory, annual housing starts would need to increase by 750,000, reaching 2.14 million starts per year in 2025, 2026, 2027, and 2028. This is unprecedented to have such a dramatic increase in residential construction within such a short time period outside of a post-recession recovery. It wasn't so long ago during the pandemic housing boom when builders tried to increase supply really quickly to meet the booming demand. However, Lambert notes, they only managed to reach 1.82 million annualized housing starts in April of 2022 before hitting capacity limits and facing skyrocketing input prices, including lumber, which at one point increased by over 300%. So how do we fix this problem of housing affordability? There is no easy answer. We need incomes to rise, mortgage rates to fall, and home prices to even out. We need more inventory without creating another home buying frenzy, which could happen if home buyers are incentivized. And we need inflation to cool and gas and food prices to come down. Back to McLaughlin's analogy of the housing market compared to the supermarket, how is anybody supposed to save money for a house when everyday living is so expensive? Well, what do you all think? What do you think of Harris's plan? Comment below and let's talk about it, because I really do want to know. Let's end with some data from Redfin's latest housing market update for the 4 weeks ending August 11th. The median sale price is up 3.4% year over year. The median asking price is also up 5.9% year over year, the biggest increase since October of 2022. Now remember, these are national statistics. Real estate is obviously very localized, so this could be different where you live. The metros with the biggest year-over-year median sale price increase are Philadelphia, up 12.5%, Detroit, up 12.4%, Anaheim, California, up 11.2%, Newark, New Jersey, up 10.3%, and New Brunswick, New Jersey, up 10.1%. The metros with the biggest year-over-year median sale price decrease are Austin, Texas, down 3%, Tampa, Florida, down 1.3%, and San Antonio, Texas, down 1.3%. New listings are up 4.5% year over year. The metros with the biggest increase in new listings are Cincinnati, up 20.7%, San Jose, California, up 19%, Sacramento, California, up 18.2%, Baltimore, up 17.2%, and San Diego, up 17.1%. The metros with the biggest year-over-year decrease in new listings are Atlanta, down 16%, Austin, Texas, down 5.4%, Chicago, down 3.9%, Portland, Oregon, down 3.8%, 3.2%. Nassau County, New York, down 3.1%. 37.1% of the homes sold in the first 2 weeks, down from 43% a year ago. 29.6% of the homes sold above the list price, down from 35% a year ago. 7% of the homes had a price drop, up 1.8 points from a year ago, nearing the highest level on record. And the months of supply is 3.6 months, up 0.7 points from a year ago. The bottom line is, it's going to be really interesting to see how the housing market responds to several things, including the new rules from the NAR settlement. By the way, if you're confused about that at all, check out this video, as well as the upcoming election, the different debates, and the possible interest rate cuts. If you missed our video on why 56,000 home buyer contracts got canceled, definitely check that out next. Thanks for watching. I do appreciate it. Bye!